Welcome to this investment strategies presentation. The reason why I've put these slides together is because I've identified something that I think is a massive pitfall in a lot of investors when they're building a portfolio. And I think that if a lot of people watch this presentation from beginning to end, I believe that it's going to change a lot of people's views on what they should be doing when investing in shares. And this quote is taken from Benjamin Graham. A very important part of the concept I'm trying to drive on this presentation. So my name is Levi. I studied economics and maths and then went on to study a master's degree in risk. I've authored two books, the first, Investment Economics and Risk, and the second, The Economics of Entrepreneurship. So a lot of investors think to themselves, I need to buy low and sell high, and of course no one could argue with that. But there's a lot of issues that come attached to that if you get in this mindset of I need to buy low. And basically some of the key ones I've identified as being investments are made purely on price. And it's so easy to buy low because all you need to do is just find all of the rubbish companies out there, the ones that are falling behind with technology, the ones that are losing market share, losing customers. They're laden in debt, they're inefficient, and they're just not making any money. Their share price will be low. And the problem is that company share prices can fall and be low for years. It doesn't mean as such that if you buy low that the market's not going to leave you high and dry. And the other issue is as well is that a lot of people don't realise this. If you find a good company, you can buy the shares but lose money on it, because if you think back to the dot-com bubble, people lost fortunes buying companies that everyone could see was the future. E-commerce, internet was the future, but just because you're right about that doesn't mean that you're going to make money buying at any price. So obviously the entry is very important when it comes to making investments, but the point I want to make is that if you buy low, it doesn't guarantee anything, and it can actually land you in a lot of problems. And this is what I think that a lot of investors are putting themselves into, these positions where they're just making their portfolio deteriorate. So this is British Telecoms, was a massive company. I believe they used to be FTSE 100. They peaked around 2015, and 5 years later the company's still falling. Tullow Oil, they peaked in 2012, so 8 years ago they peaked, and they're still falling now. And if you look at this chart, if you look back to 2015, you could actually build quite a good case of buying this at say £4 a share, because this used to trade about £13 a share. It peaked around there, and you could say £4, I think this will double to £8, I'll double my money, so let's move some money out of some of these defensive stocks that aren't really doing anything, put it in, I'll double my money, and we'll go from there. And now you're looking at 20 pence per share. Who would have called that at £4? This is the sort of mindset. If you buy low, then you could end up attracted to these sorts of investments. Stobart Group, again, another company that's fallen for 2 years, just over 2 years. Royal Mail, other than the spike in 2018, since its IPO, this has been in a bear market. And Carnival, the cruise liner, this actually peaked in 2017 and fell for nearly 3 years, and then obviously we had a black swan event which caused the price to crash off. And you could say again that if you saw the market peak and then you was waiting for an entry, you may have waited a year and paid maybe £42 per share. It's now just under £9 per share. And Centrica is a perfect example. This peaked 6 years ago, and all it's done is pretty much fall. This is a textbook bear market, and potentially not off the bottom yet. And you could have made a case 2 years ago saying this is a good investment, it's a good entry, and I'm buying low. The problem is the market's going to leave you high and dry. And some of the important things that I want to sort of drive home, because if you are someone who tries to buy low and you end up buying these companies that aren't doing very well, and you're sort of punting that they'll turn around, you could end up in situations where your portfolio is down a significant amount. And I'm going to run a few scenarios here just to show you the maths behind it. If your portfolio is down by a third, And we assume that after you're down a third, for the next couple of years you make 5% annual gains. It will take you 8.5 years of 5% annual gains just to get back to where you started. And 5% annual gains is actually quite hard to do, especially over a 9-year period. And if you make 4% annually, then it's going to take you 11 years to break even, and even worse, 3% gains, which is quite modest. I would take 3% gains over the next 5 years. It'll take you 14 years to get back to where you started if you lost 33%. And again, if you lose a quarter of your portfolio, and it's not just a case of selling at a loss, it could just be on paper you're down 25%. It'll take you 6 years of 5% annual gains just to break even. And these numbers are quite intimidating when you think about it. And this is going to link to something that I put in the end of this tutorial as well. So bear this in mind, these numbers, and what sort of impact it will have on you if you are down, say, a third or a quarter, because it's going to take quite a lot to get back to where you started. And 20%, as I mentioned, 3% annual gains is not it's not a bad performance at all, and it'll take 7.5 years to get back to where you started if you lose 20%. And people that invest in penny shares, you could be down 20% in the space of a week, and the only thing that's going to save you is how much exposure do you have to these penny shares. And again, I'm not going to go through all the numbers, you should be able to see them on your screen, so feel free to pause them if you want to take a note. And finally, an investment down 10%, and you can see 5% annual gains, which is quite good, but you're going to need to do that for just over 2 years just to make that 10% back. So I sort of mentioned that this would link to something else, and this is it. The break-even effect is something that I learned while studying my master's degree. And what it proposes is that previous investment results can influence your risk tolerance. And someone's risk tolerance, people normally consider it to be quite binary. Either I'm risk embracing or I'm risk adverse. But the reality is that people vary per situation, and I'll go into a little bit more detail as you can see on the screen. If an investor makes a small loss, it's likely to make them a bit more risk adverse. And what that can mean is that if I buy my first shares, the first time I ever invest, I buy some shares in Barclays and I'm unlucky, I buy in the morning and by the afternoon the market's down 2.5%. A small loss like that might make me think, do you know what, I was going to buy some more shares, but I'm going to wait to see if the market falls a little bit more and then I'll buy. So I become a little bit risk adverse. I don't like what I've seen. I'm making a small loss. I want a hands off. I just want a little bit more reassurance that the market's not going to go down any further. However, the other side of this spectrum, a large loss results in a break-even effect and a massive increase in risk tolerance. And how this could be is that if you say you're down 80% on paper, you buy some oil exploration penny shares, turns out that a massive well they was hoping would reveal all this oil, it's a dud, and the share price absolutely collapses. You've got massive exposure to this company because you really believe they was going to make a massive oil discovery, and you're down 80%. What that's likely to make you do is take on massive risk, because all you want to do is get your money back, and the only way you're going to do that is by investing in penny shares again and hope that you can get some that double. So a massive or quite a substantial loss can make you even more risk embracing, and the problem with taking on more risk means that you're putting your capital at risk again, all over again. And just before I get to the strategies, the things that the main purpose of this presentation, as I mentioned, I'm the author of 2 books. So if you go onto Amazon, you can click read inside and you can see the contents, and you can preview some of the sections to see what these books are all about. They each took over a year to write, so make sure you check those out. So one of the things that I have been doing for the last couple of years, and I think since I got in this mindset, I think that my results have changed a lot. And this is a quote from Warren Buffett. And I don't normally follow famous people quotes, because you can find a quote that they said that contradicts another one, but this is excellent. And it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And if you got in this mindset and you followed this, it would have kept you away from investments like Tullow Oil and Centrica, because you'd think, no, it's not all on price. It's actually to do with the company and the prospects of the company. If the prospects of the company are deteriorating and there's a good price, it's better to find something that's maybe historically a fair price, but it's a good solid company. And this is a brilliant mindset to get into. So some of the strategies, and again, some of these appear in my book, and diversification, I've got a model in one of my books which is very useful. But diversifying sectors, it sounds obvious, but I've had conversations with people before that say that they're quite well diversified because they've got a portfolio of different oil companies. And I say to them, yeah, but you've concentrated oil price risk. If there's a black swan event or something happens in the oil market and oil drops by 20%, every single one of your stock is going to go down. It's best to, not just for risk mitigation measures, but to try to, it can maximize your potential upside. If you own a financial stock, a commodity stock, a renewable energy stock, a pharmaceutical stock, maybe one of the niche stocks, there's a chance that there may be a boom in one of these sectors that you wasn't expecting that causes one of your shares to outperform the market that year. The more you spread your assets, the more likely that is to happen. But the other thing is that if you concentrate in one area, let's say that you have a family member who's a pilot and they say, oh, airlines are the place to be, and you know a lot more about the average person than airlines. You could buy a couple of airlines, but the issue is that one event is probably going to take out a lot of value out of the whole airline industry. And if you're overexposed to it, it's going to really hit your portfolio, and you're going to find yourself in one of these scenarios, such as being 33% down. And then you know the maths on how long it's going to take you to get back to break even. Another thing with diversification is that you should diversify the timing of your purchases. Unless you are in a bull market and you know that the longer you leave it, the higher price you're going to pay, that's a completely different thing. But if the market's sort of trendless, diversify the timing, because you don't just, if you've got £10,000 to invest, you don't want to do it all in the same week, because if the market falls for 2 weeks after you've invested, your whole portfolio is going to be underwater. Whereas if you only buy 10% and then the market drops, you buy another 10%, it's a much better way of diversifying the timing of your purchases. And this is a massive, massive point. Never sell a good stock to purchase a fallen one. Let's say that you was invested in Centrica or Tullow Oil, and you had 10% of your portfolio in there, and you watch it go down by 40%, and you think, this is going to turn around. Let's sell some of my Admiral insurance shares. So you sell Admiral, you buy Tullow, and then the bear market carries on going, and then you end up massively exposed to a falling share. And then after a while, you start doubling up because of the break-even effect, as I described in the other slide. You know that as your portfolio starts to hemorrhage value, you're going to end up making bigger risks, and you could lose a lot more. Boring is beautiful. Always own a defensive company. They're so important, because when there's a stock market crash or a massive crisis, the defensive companies are the ones that hold their value. But not only that, they're less likely to cancel dividends. If you go taking money out of any defensive positions that you have to buy something that's a lot more sensitive to the market or the economic cycle, because you think it's going to recover quicker, you'll end up with a portfolio of shares that aren't paying dividends for 2 years, for example. So always have something that's defensive. And this again is very important. Do not react every time a market drops. People get into the sort of mindset that if the market falls, I have to do something, because if the market falls by, say, 15%, there will be some of your portfolio that falls a lot more than others. And then people start having this mindset where they have to do something, because what I should do is sell the stock that's hardly moved and buy the one that's been hit the hardest, because if they sort of revert back to where they was, I'll make more money. You don't have to do that. And this brings me on to my final point: ignore the noise. You don't need to know share prices all the time. And again, referring back to something that I put in one of my books, I said that a lot of the rich families in the world made their wealth through owning property. And there's two reasons for that. Number one, a lot of countries have had bull markets in property. But number two, when you've got a lot of wealth tied up in property, you can't speculate with it. It's tied up in brick and mortar. And it's the speculation thing that can lose fortunes. If you just buy and hold good assets, you will make money. And that brings me to the end of the tutorial. I really hope that you found this useful. And don't forget to subscribe, because there will be a lot more presentations like this coming soon. Thank you.